Wealth cannot be created in a single day, but there's nothing stopping you from accumulating enough over time if you're consistent and disciplined with your investing. And what better way to start that journey than making your plans now? Welcome to the Millionaire Mindset. In this video, we would be revealing the best ways to build your wealth in 2023. If you haven't joined our community, be sure to hit that subscribe and bell icon so you never miss any of our quality lessons. The wealthy don't work for money. Instead, they let their money work for them. What better way to make your money work for you than to invest in stocks? In case you're still at a crossroads in how to build your wealth and still be safe from inflation, Elon Musk and Warren Buffett have both advocated similar methods to tackle this. In simple words, one of the best ways to be on the good side of inflation is to own a part of what they call a wonderful business. This is because the company's goods will continue to be in demand regardless of what happens to the value of the dollar or any other currency. So, how do you own a part of a wonderful business? You buy stocks. Not all stocks are the same. There are growth investing stocks and value investing stocks. Value stocks typically give investors the chance to buy shares at a discount to their true value, whereas growth stocks give a promise of the potential for higher returns. Now let's examine them from the angle of a direct investment in a company. Consider those companies that analysts believe have the potential to outperform the market as a whole as growth stocks, and those companies that are now trading below their true value and will therefore offer a greater return over time as value stocks. Easy, right? So if value stocks give the promise of higher returns, even though you don't currently see them, and growth stocks, on the other hand, are almost ready to give you quick profits, which then should you invest in to build your wealth? The first thing you have to keep in mind about these investment strategies is that they both have strengths and weaknesses. They also behave differently depending on the stage of the business cycle the economy is in. And let's not forget how your investment duration is also a factor. More about that later. You can easily recognize growth stocks by keeping an eye out for those businesses that routinely provide above-average earnings growth. These stocks often don't have a long history of huge gains, but they offer the potential for quick growth. Share prices of growth stocks also fluctuate more frequently. The aim of investors purchasing growth stocks is usually to benefit from the quick price increase of the stock, rather than receiving income from dividends. Apple and Tesla are two examples of businesses that are regarded as growth stocks, as both have established solid reputations for good returns over the years. On the other hand, you can tell if a stock is a value stock if its current market price is lower than its intrinsic value. Comparing the market valuation with the company's real value is all you need. This can be done using information from financial statements, business plans, and the company's overall competitive position. Value stocks steadily increase in value over time regardless of market conditions. They can, however, be easily overlooked because their stock price is so low that the company's potential for future earnings can easily be underestimated. According to S&P Global standards, Procter & Gamble and Coca-Cola are both considered value stocks. Both businesses have also increased their dividend payments for at least 60 years. Warren Buffett is one of the most well-known value investors through his holding company Berkshire Hathaway. Now, before choosing your investment approach, why not consider the duration of your investment? Will you be looking at making a long-term investment or a short-term investment? The truth remains that you can build your wealth from both, but the question is this: which is going to give you more profits? Generally, long-term investments are those held for more time than a year, and short-term investments are those held for a shorter time. Although any asset class is appropriate for both short and long-term investments, some are more suitable for one or even both. For instance, stocks would do well in either time frame. It just depends on which you invest in. While short-term investments are sprinkled with a significant amount of risk, they can also be valuable in your portfolio as you create your wealth. The main advantage of a short-term approach is that when executed well, it can produce huge returns quickly. You can then reinvest and continue to grow the overall worth of your portfolio. As sweet as this sounds, don't forget that taxes would come knocking too. Gains made from short-term sell-offs are subject to regular income tax rates. As a result, if you earn a lot of money from short-term investments, you can find yourself paying higher taxes, which could reduce your income. You may now begin to see long-term investments as a better option. Don't get carried away, however, as the lesser risk it promises results in possible lesser returns. The likelihood of a large gain is substantially lower than with a market-timed investment, which you get with short-term investments. Inflation can also cause your gains to lose most of their value during the time you held them. But look on the bright side. When you do cash out, your tax liability will be low. The government will only take a smaller percentage of your earnings than it would if you had earned your profits more quickly. Long-term capital gains are taxed at a rate between 0% and 20%, so you get to keep a larger bulk of your money. A chunk of our time has been spent talking about stocks because they remain a proven way of building wealth, but they are not the only option you have. Another investment that can make you wealthy is real estate. Real estate is one investment that seems to always generate a higher return on investment. Besides the economic crisis that temporarily disrupts the upward value trajectory of properties, you can always be sure that your properties would continue to be worth more every passing year. Depending on how much money you're willing to invest, there are several ways to invest in real estate. One of the best options is to invest in real estate investment groups, known as REIGs. REIGs allow you to participate in real estate investment without having to directly buy and maintain the property. The company brokering the REIG does all the work for you. In the end, you get a share of the property. Rental REIGs are very good if you want something you can invest in for the long term. So consider these wonderful investment packages. Just ensure you do your due diligence and go for a company that has a track record you can trust. Similar to REIGs are real estate investment trusts, also known as REITs. A REIT is just like a stock because you're buying into the equities of the offering entity. They are also tradable, meaning you can sell them off at any time. Exchange-traded funds for REITs, or ETFs, have low expense ratios and passively track market indexes. These ETFs track indexes of the general real estate market in a passive way. They are comprised of a number of different types of REITs as components. Investors can gain exposure to the larger real estate sector by tracking an index rather than investing in individual companies. Another strategy is to flip properties yourself. The reward is greater than investing in bundled real estate investments as described previously, but you would have to do a lot of work and spend a lot of money. This involves buying a property, renovating the property, and reselling it. To be successful here, you need to have an eye for properties that are undervalued and always have the cash ready, so you never miss a bargain. You can also consider investing in mutual funds. The goal of a mutual fund is to purchase securities for many investors by pooling their money. Annual returns can be high, but you can also enjoy a monthly return even to live off. You can accomplish this by investing in a mutual fund scheme that offers SWPs, or systematic withdrawal plans. Your investment in a mutual fund scheme can be withdrawn on a monthly or quarterly basis through SWP. There are several opportunities to grow wealth, but these are some of the safest and most rewarding you can try. So, as you choose the best investment type that works for you, and trust me, both types hold good promises, ensure you select the appropriate investment duration that would give you the utmost returns. Or, just to be on the safe side, simply combine both growth and value stocks so that you can enjoy the benefits of both worlds. If you enjoyed this video, be sure to click the like button and also subscribe to the channel for more content like this. Thanks for watching and see you in the next video.